In this video, I will be introducing fair value measurement. Accounting rules allow for us to measure assets and liabilities using different methods depending on the underlying item. Some examples that you should be familiar with are historical cost, current cost, or replacement value, and net realizable value. We use historical cost when recording property, plant, and equipment at its purchase price. We use replacement value and net realizable value when we are accounting for inventory. Fair value is another measurement base allowed by US GAAP. In the last chapter, we talked about using fair value to account for investments. However, the fair value was just given to us, and we did not attempt to understand how it was derived. We're about to remedy that. Fair value is market-based. In other words, we are interested in the value of the item as determined by a market full of individuals rather than the value of an item to any one specific individual. To determine a fair value, we will identify a principal market and hypothetically sell our asset or transfer our liability into that market as of the measurement date. Whether we are actually planning to sell our asset or not is irrelevant. When we are carrying out our hypothetical sale of our asset into the market, we should consider any characteristics of our asset that a participant in the market would care about when determining how much they would be willing to pay. Let's consider a transaction that many of us are familiar with: buying a new car. When you last shopped for a car, what attributes were important to you? Okay, so some pretty typical requirements in there, besides the windows. That one's a little odd. Now, has anybody ever used Kelley Blue Book when selling a car or trying to value a car they're interested in buying? What are some attributes that they ask about? Right, so a pretty similar list. So it appears that Kelley Blue Book has determined that these are the characteristics that are important to most market participants when determining what they're willing to pay for a car. Things like the windows, sorry Annabelle, are more of an individual preference and therefore aren't included. Various accounting standards require or allow the use of fair value measurement. However, the definition of fair value remains the same across all standards. That definition is the price that would be received to sell an asset or transfer a liability in an orderly transaction between market participants on the measurement date. Let's break that definition down a little bit. So the first part is the price that would be received to sell an asset or transfer a liability. This refers to that hypothetical transaction in the marketplace that we discussed before. In an orderly transaction between market participants refers to the fact that all participants must be independent and not acting under duress for the transaction to be a true indicator of value. On the measurement date means as of the date that we need to know the fair value, such as our financial statement reporting date. In other words, the definition describes an exit price, or what we would get were we to sell our asset. Let's look at an example. In this example, we have Grantham Company purchasing a piece of machinery on March 1st, 2010 for $100,000. The company paid $20,000 cash on that date and borrowed the remaining $80,000 from a local bank. On September 30th, 2010, the company sold the machine for $90,000 and paid the bank the $80,000 owed. All right, so a couple questions here just to get us thinking about entry versus exit pricing. So what's our entry price? Well, our entry price is whatever it cost us to get into the ownership of this item. So they told us that we paid $100,000 for it. So our entry price is the same as our historical cost, or $100,000. Next, it asks us about our exit price. So what's our exit price for the machinery? Well, that's where we're going to sell it into a hypothetical market. Well, in this case, we didn't sell it into a hypothetical market. We actually sold it. And so when we sold it, what did we get? We got $90,000. So our exit price is $90,000. Well, what about the $80,000 that we owed? That actually has nothing to do with our exit price. That just happens to be how we finance this transaction. So our exit price doesn't have to do with the cash that we get to keep or even the cash flows. It's what the value of the machine was to the market that we sold it into. In this case, that was $90,000. So finally, it asks us on September 29th, 2010, what was the fair value of Grantham's machinery? So we actually sold this on September 30th. And so we know that on September 30th, it was worth $90,000 because that's what the market paid for it. But the day before, we would have to hypothetically sell it into the market. And so it's probably a pretty good guess that on the day before it was worth $90,000, it was also worth $90,000. So here, our fair value would be $90,000. Now, in reality, we don't have to actually sell our asset in order to make a fair value assessment. In this case, it's just easier to see how if we did actually sell it, that would give us a pretty strong indicator of its value. Once we have determined the exit price, which I still haven't told you how to do, we need to make a few adjustments to that value before recording the asset or liability on our books. We will need to adjust for transformation costs and transportation costs, but not transaction costs. Let's take a look at an example where I'll explain these adjustments in greater detail. In this example, we have Big Land Company that has a piece of agricultural machinery that is 10 years old. The machinery is located in Illinois, and Big Land intends to sell the machinery in its principal market, which trades primarily in the state of Ohio. The machinery has not been used in several years, and Big Land must have it reconditioned in order to be operable, which will cost $100,000. The equipment will also need to be transported to Ohio at a cost of $10,000. Finally, Big Land will incur sales commission of $30,000 in order to sell the asset. Big Land has determined that the exit price of this asset is $400,000 after reconditioning, based on comparable sales of identical machines in the Ohio market. Okay, so the first thing they want us to do is determine some attributes of the machinery that were likely important in determining the $400,000 exit price. So let's think about it. Things that are going to be important. What does this machine do? So the fact that it's used for agricultural purposes. We also need to think about the condition of this item. So it's not brand new, it's 10 years old. So if we had the value of an item that's identical but brand new, that's going to be a different value than one that's 10 years old. So we need to take that into consideration. They also told us that the price that they quoted us here, this exit price of $400,000, assumes that it's been reconditioned. So that's going to be an attribute that's important too, because if we don't have it reconditioned, it's going to be worth less. And then finally, they tell us that we need to transfer this thing to Ohio in order to get this exit price. So it's far from its principal market. Again, we could sell it here in Illinois, but if we did that, we're not going to get the $400,000 exit price. So we would have a different exit price if we weren't planning on transporting it to its principal market. Okay, so now we're going to try to figure out what amount we would put on our balance sheet related to this item. So we're going to start with our exit price, which was $400,000. Now remember that $400,000 is conditioned upon the fact that we are going to recondition this asset. If we don't recondition this asset, we don't get $400,000. So for fair value accounting purposes, we're going to deduct the costs that it cost us to get us up to that exit price. So they told us that our reconditioning would cost us, would cost us $100,000. So our transformation costs are $100,000. So what this assumes is that the extra value we're getting is more than $100,000. So say we had an asset that was $200,000. We'd be willing to pay $100,000 to recondition it and get it up to $400,000. In the next line here, we have transportation costs. So we also have to transport this asset in order to get that $400,000 value. That's going to cost us $10,000. So we're going to put $10,000 that we also have to deduct from our exit price before we can put this on our balance sheet. So our fair value is going to be our exit price minus the $100,000 of transformation costs required to get to our exit price, minus the $10,000 of transportation costs required to get to our exit price, and that's going to give us a fair value of $290,000. Notice in our example, we did not adjust our exit price for transaction costs, our sales commissions that we were going to have to pay. The reasoning here is that those did not actually impact what we were able to get for our exit price. So remember, our reconditioning and our transportation, those both allowed us to get a higher exit price. So they helped in determining that $400,000. Our sales commissions aren't an attribute of the asset that are going to help us get a bigger exit price in the market. That's just something that for our own convenience, we've decided to use a broker. So those are not going to be deducted from our exit price when we record our fair value on our balance sheet. This concludes our introduction to fair value measurement. Don't forget to email any questions for our discussion.